Cathie Wood.
Cathie Wood.
Cathie Wood.
Welcome back to Tolu's Notes. Today, I'll be discussing some of the problems with investing in disruptive innovation using ARK and their favorite stock, Tesla, as examples. Let's begin. If you clicked on the video, there's a good chance that you already know what ARK is. ARK and its visionary founder, Cathie Wood, aim to invest in disruptive innovation. Their homepage, arkinvest.com, mentions disruptive 16 times and innovation 60 times. The industry is taking note. ARK grew by 649% in 2020, measured by the net inflows of capital into their firm. Investors obviously love their offering, though this could be due to their recent performance. My take on ARK is a bit different. I love their theme. As a technologist, I love their focus on artificial intelligence, robotics, genomics, and fintech. I believe we're moving into that future and that the future will be better than the past. But as an investor, I'm wary of investing in innovation when capital is bountiful and recent performance has been incredible. To be clear, I'm not one to shy away from risk. I believe you need to embrace risk if you want to get rewarded. But I think there's a better way to invest in innovation. The way innovation spreads is interesting. First, no one cares, then a few people care, followed by the late adopters. However, when it comes to money, most people only care to invest when they see others investing. Take Tesla, for example. Why does everyone suddenly want to buy Tesla at $800 a share in 2021 when they dismissed the stock at $63 a share just 3 years ago? Elon Musk has been saying what he plans to do since then, so why now? Uncertainty is one of the main reasons why disruptive companies command higher multiples. For example, Apple cannot command the same multiples as Tesla because the space Apple is innovating in is widely known and adopted. iPhones, MacBooks, services, these technologies are essential, but they won't change how the economy works because they already have. On the other hand, if self-driving gets adopted, society must rethink everything from transportation to real estate. Why buy a shack in a city like San Francisco for $1 million when you can live in a 10-bedroom on a farm and commute safely and effortlessly to work while sleeping? My point is that genuinely disruptive technology moves society to the next level. Electricity was disruptive, so were the railway, the computer, and the internet. The blockchain is disruptive. These technologies help us leverage what we can achieve as a species. Thanks to electricity, we got the computer, and then we got the internet. And because of all three, I'm able to transfer information from my brain to yours without ever meeting you. I know Apple is also working on self-driving cars, but they are stuck in the current economy. Investors expect them to spend most of their resources on technologies that have already been adopted. On the other hand, Tesla can spend all their money working on projects that may seem out of reach. Apple's changes could very well be innovative, but at most, it will be a step function that continues to work within our current paradigm. Tesla's, however, could change everything forever. People investing in disruptive technologies are betting on three things, each with its own set of risks. First, that the company can actually create the technology. Then, that the technology will be widely adopted by the public. And finally, that its adoption will disrupt the current economy by helping us be more productive. There are so many unknowns, which explains why these stocks are so volatile compared to the rest of the market. There are three groups of Tesla investors. There are a few who know what they're doing, there are those who don't know, and there are a lot who aren't aware that they don't know. If you dismiss Tesla in 2019, but are praising it in 2020 or 2021, I'd like to know why. I have a few guesses, but comment yours down below. Studies have shown that we are pleased with what we have until our neighbors show up with something better. It's one of the reasons market cycles occur. We typically overinvest when market conditions are excellent and underinvest during the best opportunities. Investors are usually hesitant to invest in disruptive technologies until other investors start making money. It leads to many investors wanting to get in on the fun all around the same time, regardless of price. This pattern has repeated itself throughout history. Railways changed the world, but not before investors got greedy by throwing money at railway projects regardless of price. And more recently, the internet changed the world, but not before investors got so greedy by throwing money at companies that were innovating just by coming up with catchy domain names to buy. Buying disruptive technologies regardless of price only works as long as there's still a lot of uncertainty surrounding the technology. Electric vehicle penetration is still very low, and self-driving is virtually non-existent as far as most consumers are concerned. In a blog post I sent out in early January, I discussed how uncertainty is a good thing for Tesla stock. If investors can't put the company in a box, its shares can indeed go to infinity. But if everyone knows what Tesla is and what Tesla can do, then the market can draw an accurate box around it. I said the uncertainty surrounding the stock will vanish once the public markets can place Tesla in the correct box. The box may be fancy, unlike the traditional boxes we're used to, but it will be a box. Cathie Wood knows this.
What happened last week came clear to me is the analysts following this stock don't know how to analyze it because it's not a technology stock. It is that. It's not a car company. Yes, it is. Battery. It's utility. It's something for everyone, and no one can pull it all together.
Early on, she realized that analysts have been trying to fit Tesla into some of the old boxes that fit into our current paradigm. The adoption of EVs, self-driving, and all the other disruptive technology that Tesla is working on will remove some of the uncertainty Tesla investors have to deal with. How the stock will react is still unknown, but less uncertainty is mostly a good sign in the public markets. But the box will let us know if the stock is overvalued or undervalued. At that point, the only important figure is the price that you, the investor, paid for your shares. Oddly enough, a bet on large-scale adoption could very well be a bet that the shares will fall. Investors can often make more money betting on old, ignored, boring companies, while the new and exciting companies get bid up in price. Researchers showed that holding the companies in the original S&P 500, the original 500 stocks in the OG S&P 500 created in 1957, those investors would have outperformed the updated index with lower risk. They found that declining sectors like energy outperformed expanding ones like information technology for several reasons. They pointed to the internet bubble, but also the temporary overvaluation when the index announces that it will add a company. This happened very recently with Tesla. Their shares skyrocketed after the S&P 500 announcement. ETFs and indexers that track the S&P 500 have to buy the stock regardless of what price it's trading at when the announcement was made. It is difficult to judge ARK's performance with interest rates being so low. Most of the companies that ARK invests in are growth companies that directly benefit from the lower discount rate created by the interest rate environment that we're in today. I'm interested in how ARK will perform when interest rates start rising, if they ever will. I think investors should be buying investments with high expected future returns. Most of the companies in ARK's portfolio have had substantial unexpected returns. This means that their expected returns going forward are relatively low regardless of how impactful and disruptive the technology is. The price you pay for a stock is more important than the underlying company's potential. An investor that buys a mediocre business at reasonable prices can get higher returns compared to someone that chases the hottest stock at high prices. I don't think I'm getting a good deal with ARK. I believe in their portfolio companies and hope they succeed, but I won't be investing because I can find better returns elsewhere. But that's another topic for another day. Remember, this is not financial advice. You're responsible for your own money. I don't give financial advice. All this disclaimer stuff here. Read it. Thanks for watching. Till next week, this is Toll's Notes.